Welcome to this explainer. Go ahead and pull up a chair, because today we're walking through the battle-tested mathematical blueprint for generating $500 a month in purely passive income. Now, $500 might sound like a bit of a daydream right now, but once we break down the actual math, you'll see it absolutely transforms into a highly actionable plan.
But hey, before we run the numbers, we've got to clear the air on a massive misconception. Most folks just completely dismiss dividend investing before they ever give it a serious look. They hear the word dividends and immediately picture, boring retirees clipping coupons or these ultra-conservative portfolios doing absolutely nothing while everyone else makes the real money. Well, hold on to that image and you are literally costing yourself one of the most reliable wealth-building engines ever created.
Let's actually look at the completely different worlds of growth versus dividend investing, because this is where the profound psychological benefits of passive income really shine. Think about it. When you own a growth stock, your entire success hinges on the constant low-level anxiety of hoping someone, somewhere, is willing to pay more for your shares than you did. Your success requires a buyer. But dividend income, that cash consistently lands in your account whether the market is ripping higher or completely melting down. It's a completely different psychological framework. That absolute peace of collecting cash, no matter the market sentiment, completely changes how you experience investing. It literally removes the panic.
Okay, to build this out from the ground up, we first need to lock down the basic math, and we're starting with dividend yield. This is simply calculated by dividing the annual dividend payment by the current share price. So, let's say you've got a stock paying $2 a year in dividends, and it's trading at $40 a share. That gives you a simple 5% yield. That's it. That is the fundamental equation dictating your cash flow.
But listen closely here. As someone who's been doing this a long time, beware the ultra-high yield trap. Chasing a 10 or 12% yield when comparable, healthy companies are paying maybe 3 or 4, yeah, that's a giant warning sign. It usually means the market is pricing in a massive probability that the company's in trouble and that dividend is on the chopping block. Blindly chasing those double-digit yields without knowing exactly what's under the hood is a trap. It'll break your heart and your portfolio.
Right, so let's talk about the actual honest capital required to hit that $500 monthly target. To get $500 a month, you obviously need $6,000 a year in dividend income. At a realistic average portfolio yield of 4%, you are going to need a portfolio value of exactly $150,000. These are real numbers that require real capital.
Now, what's fascinating is how this math scales depending on your yield. If you play it ultra safe with a portfolio yielding 3%, you're going to need $200,000. Push that yield to 5% and the capital requirement drops to $120,000. Seeing it laid out like this, it's a bit of a sobering reality check. It proves right here, in black and white, that this is a get wealthy slowly strategy, not some get-rich-quick scheme.
Now, if you're looking at those capital requirements and thinking, I don't have 150 grand just sitting around, do not panic. Most people don't. Not having it right now simply means you're building toward the destination. The daily, active process of building toward it through regular, disciplined contributions, that's the actual secret to long-term wealth. You don't just start at the finish line, right? You have to build the engine piece by piece.
And to build an absolutely unshakable foundation for that engine, we don't just want companies that pay dividends, we want dividend growers. Specifically, we're hunting for that elite group known as dividend aristocrats. We're talking about S&P 500 companies that have consecutively raised their dividend payout every single year for at least 25 years.
Think massive, household names. Johnson & Johnson, Procter & Gamble, Coca-Cola. These battle-tested heavyweights are the bedrock of reliable income. Why? Well, think about what's happened over the last few decades. They didn't cut their payouts during the dot-com bust or the 2008 financial crisis, or even a global pandemic. When things got incredibly terrifying for the rest of the market, these companies actually raised their payouts.
And that track record brilliantly illustrates why dividend growth matters so much more than just your starting yield. It all comes down to a concept called yield on cost. This is your dividend yield calculated on the original price you paid for your shares. So as those aristocrats keep raising their payouts year after year, your yield naturally compounds. This means the income stream you start building today at a totally modest yield can become genuinely life-changing a couple of decades down the road.
Check out how this compounds over a long horizon. It's almost unbelievable. Let's say you start with a simple 3% yield today. If that company grows its dividend by 8% annually, by year 10, that's transformed into a 6.5% yield. But wait 20 years, it becomes a massive 14% yield on your original investment.
That's the quiet, relentless magic of the math doing all the heavy lifting for you. Now, of course, even if you're holding aristocrats, a truly durable portfolio avoids concentration risk. You achieve this by intentionally spreading out across different sectors. You want to balance the boring but honestly beautiful stability of consumer staples right alongside the predictable, regulated income from utilities. Then you mix in the massive distributions of REITs, which are legally mandated to pay out 90% of their taxable income, along with the substantial yields you often find in energy.
But what's the right mix? Well, as a veteran rule of thumb, you should never let a single sector exceed 25 to 30% of your total portfolio. By capping your exposure like this, you protect yourself from the concentrated, agonizing pain of an industry-specific downturn. So if energy prices suddenly collapse or real estate takes a beating, the rest of your portfolio just keeps that income flowing totally uninterrupted.
Now, I know the thought of picking individual stocks across all these different sectors can feel super overwhelming, especially when you're just starting to accumulate assets. If that's where you're at, low-cost dividend ETFs, tracking indices like the Dividend Aristocrats, are an incredible instant foundation. With just a single purchase, you get immediate diversification across dozens of world-class dividend-paying companies. It's a great way to start while you take time to learn the ropes.
All right, let's talk about your ultimate weapon in this journey. The Dividend Reinvestment Plan, or DRIP. This is your automatic compounding cycle. You earn a dividend, your brokerage automatically uses that cash to buy you more shares, and then those new shares earn even more dividends. It's a relentless, automated engine where your money aggressively buys more shares to print even more money. It dramatically accelerates your timeline to that $150,000 goal.
As we wrap up this explainer, I want to leave you with the deepest psychological truth of this entire strategy. Here's the part almost no one talks about. The $500 a month, that isn't actually the goal. The true prize here is the financial resilience that fundamentally changes your relationship with market volatility. Once you have this income stream, you stop viewing the stock market as a terrifying casino that ruins your day, and you start viewing it as a machine that just works for you.
Because when your income arrives like clockwork, regardless of whatever terrifying news is looping on TV, a market crash completely changes its nature. It stops being a catastrophe that keeps you up at night. Instead, it literally just becomes a massive clearance sale on the exact assets you want to own forever. So as you chart your own financial path, I've got to ask, when the next inevitable market crash hits, are you going to be panicking or will you be getting paid?